Welcome back. The Bank of Canada has, as expected, held its policy rate steady at 4.5%. Those headlines are just moving across the screen from our partners at Bloomberg News, who have been in the lockup and are reporting on the move by the Bank of Canada today, holding pat. Let me read from the statement for you. The Bank of Canada today held its target for the overnight rate at 4.5%, with the bank rate at 4.75%, the deposit rate at 4.5%. The bank is also continuing its policy of quantitative easing. No surprises there. Here's what the bank says in paragraph number 2. Inflation in many countries is easing in the face of lower energy prices, normalizing global supply chains, and tighter monetary policy. At the same time, labor markets remain tight, and measures of core inflation in many advanced economies suggest persistent price pressures, especially for services. Moving further down the statement, the bank says, quote, in Canada, demand is still exceeding supply and the labor market remains tight. Economic growth in the first quarter looks to be stronger than was projected in January, with a bounce in exports and solid consumption growth. While the bank's business outlook survey suggested acute labor shortages are starting to ease, wage growth is still elevated. So there you see the Bank of Canada pointing to growth that was stronger than expected, perhaps adding to inflationary pressures. The bank says at the bottom of its statement, the final paragraph, in light of its outlook for growth and inflation, Governing Council decided to maintain the policy rate at 4.5%. Quantitative easing continues to complement this restrictive stance. Governing Council continues to assess whether monetary policy is sufficiently restrictive to relieve price pressures and, here's perhaps the key sentence, remains prepared to raise the policy rate further if needed to return inflation to the 2% target. The bank remains resolute in its commitment to restoring price stability for Canadians. Let's get some expert reaction now as we take a look at the bond market in the immediate aftermath of the bank's decision. Again, the bank has held its rate steady at 4.5%. Says it's willing to raise rates in the future if necessary. We're joined now by Earl Davis. He's head of fixed income and money markets at BMO Global Asset Management. We're also joined by John Manley. John Manley is senior advisor at Bennett Jones and, of course, a former deputy prime minister and former finance minister of Canada. Earl Davis, let's start with you. What do you think?
Yeah, largely as expected. We expected a pause, but a hawkish pause. Not to say that they're about to raise rates, but you know what? They're still remaining vigilant. And I think that came through in the statement. Another thing that they said or alluded to is that getting from 3% CPI to 2% CPI is going to be more challenging than expected. So again, a lot of statements saying they're still on pause, but they're looking at the data and remain vigilant. You
were expecting a more hawkish tone. Have you seen that in what we've learned so far?
I think that's largely reflected in what you said in regards to growth coming in higher than expected, wages remaining sticky. All this points to a stickier core inflation. As long as people are employed, they will spend on services, and we're seeing core above 5%. That means pass-through is still there. So they just want to make sure they get down to 2%. So,
John Manley, your reaction to what you've heard so far from the Bank of Canada?
No, I think that's a good summary of it. We clearly, the bank is still putting its foot on the brake here. It still sees inflation as an ongoing problem. We haven't seen the economy slow as much as many expected that it would, with the pressure on interest rates. And so it is a kind of a hawkish stance. What's interesting to me is there is no kind of reflection on what monetary policy may have contributed to some of the banking uncertainty that we've seen in the United States and Europe. So nothing there. And really, anyone who was looking for a signal from the bank that lower interest rates are coming soon, along with the spring flowers, would be a little bit disappointed.
Is the Bank of Canada, John Manley, getting the job done? The last time we had an inflation print here in Canada, the annualized pace of inflation came in at 5.2% in February. That was down 70 basis points from 5.9% in January. And the bank is sticking to its forecast that inflation will be running at 3% by the end of this year and 2% by the end of 2024. Are the rates working? Are they doing what the Bank of Canada wants them to do?
Well, I think you could say that Yeah, based on the first quarter, they have met the expectations that they tried to set for that. So I think they'd be encouraged by that. I have to say that I don't think they got a lot of help in the federal budget, which is still, from a macro point of view, highly stimulative. Big deficit being run. No fiscal restraint really demonstrated, other than reducing travel expenses and contracting out fees. And underlying this, it's leading some of the news stories today, is a lot of pressure from unionized workers for wage increases, starting with the biggest union in the country, which is the Public Service Alliance of Canada, which has very significant demands on the table with the federal government, which is, after all, the largest employer in the country. And they will set, depending on where they settle their wage increases at, they will set a standard that other organized workers are going to be looking to meet. So there's a lot still happening out there that I think would give the bank pause.
Earl Davis, same question to you. Are the rates working sufficiently to bring inflation down?
Well, I think there's two questions. Yes, they're working because you're seeing inflation come down, growth moderate. The question is, are they working fast enough? And that's a worry there. And that if you base it on employment, you'd say no. If you base it on what we saw in growth, you'd say no. And I think there's some important things that John touched upon in regards to monetary policy and what happened with financial stability. That was not mentioned in this statement. The Fed has been emphasizing that financial stability, that credit impulse is lower, they don't need to hike as much. That did not come out here. So I think the first implication is you got to take out, the market's still discounting eases, 50 basis points worth of eases by the end of this year. You have to assume that rates will, at a minimum, remain the same.
What about the point that John makes about public sector wage negotiations? You made that point as well in some notes that we asked you for prior to this meeting. How influential will be a big settlement with unionized workers at the federal level? Yeah,
and one strike vote was there. That was CRA. They're negotiating. They're ready to strike before the end of this month, and they're asking for 30% wage increases before the end of within 3 years. 30%, and that's 35,000 employees. Now you have another 125,000. Asking for 5% a year. Again, these are very important because not only from a public sector, but they set the tone for the other unions. So this month is a very important month from a wage inflation perspective.
John Manley, the Bank of Canada is saying that gross domestic product growth in Canada expected to be 1.4% this year. That would represent a significant deceleration from what we saw in the first quarter when gross domestic product growth ran at some 2.8%. Is that realistic for the economy to slow down that degree during the remaining quarters of 2023?
I think so. And I think the good news there is that those are positive numbers and not negative numbers. I think many of us feared that with the degree of deceleration being applied through monetary policy, we'd actually see a couple of negative quarters, which would constitute technically a recession. So it feels like a soft landing in terms of the economy. And as we were saying, employment figures remain high. And so if people are working, then they're also going to be spending. So I think that's quite realistic. I think the bigger worry is, can they actually get the inflation target that they're seeking?
Earl Davis, same question to you.
Yeah, I do think it is realistic, and you have to remember, you mentioned 2.8% this year so far. Their forecast was 0.5%.
Right.
So you got to take it with a grain of salt is what I'm saying. But so 1.4 is realistic. That would be a good thing, to John's point. That points to a soft landing or a no landing, and that's what you want. I think Q4 this year would be a telling year from a growth economy perspective, not just for the next quarters upcoming, but for the next years.
The bank says in its monetary policy report, it has a box that summarizes the changes in the economic projections since the January monetary policy report. And it says something that I think we all realize: job gains have been stronger than expected. This reflects both unexpected strength in the labor demand and increases in labor supply. How do we reconcile, Earl Davis, the bank's desire to bring down inflation with a persistently strong labor market? We've already talked about wage increases.
Yeah, it's a worrisome question because the bank only has one tool, basically, and that's interest rates. And how you bring that down, it means, maybe 4.5 isn't terminal rate. Maybe it's 5.5, maybe it's 5. It's to be determined. And they're trying to buy some time to figure that out. So I think the next NPR will have a very clear outlook, which is basically 3 months, on their bank perspective going forward and whether or not they have to continue to hike rates.
John Manley, you referenced the most recent federal budget and said that you don't think the Bank of Canada got a lot of assistance from the federal government. The Bank of Canada does indeed note in its summary of changes from the last monetary policy report, new fiscal measures announced in the recent federal and provincial budgets, adding about $25 billion over the next 3 years, also support gross domestic product. Is the bank trying to say something between the lines there?
That's a very gentle way of saying you've got your foot on the gas while we're trying to tap on the brake. I mean, when you look at the deterioration in the federal fiscal position between the fall fiscal update, just a couple of months later, we have the federal budget and the year that has just begun, the 1st of April, we have a deterioration of $10 billion. That's a lot of spending that's going out. And regardless of what it's being spent on, these may be good things. You can argue, do we need this? Do we need that? But it washes through the economy, and that will really act contrary to the pressure that the bank is trying to apply. So I think they'll be they're noting that. Remember, this 2% is an agreed upon target. It's agreed upon between the government and the Bank of Canada. The bank is otherwise independent, but in making that agreement, they more or less have to be counting on the finance department to produce fiscal numbers that support getting to the target. It is a mutually agreed target, and that's pretty tough to say that that's happening when you see the level of spending that's come out of the federal fisc.
Earl Davis, we've talked a bit about the banking pressures in the United States, the collapse, of course, of Silicon Valley Bank on March the 10th. We do indeed see the Bank of Canada predicting in the U.S. tightened lending conditions, higher funding costs for U.S. banks. I don't see any kind of immediate read-through to what this might mean to Canada. What might it mean to Canada, the banking strains in the United States? We hear a lot of economists and portfolio managers say that they expect a credit contraction in the United States, less money available to be borrowed.
Yeah, well, to begin with, our banks are in solid state, very stable. We're confident in them. We're investing in them, tell you the truth right now. Where they get impacted is they do have a big footprint as well in the U.S., so maybe on the margin it affects their revenues, but it doesn't impact their safety or the deposit run. We're very stable, very good here, and I think that's been acknowledged in the statement.
John Manley, yes.
I agree with that, but I'd also say one thing to keep an eye on here is what the regulator is doing. The regulators increase the buffers that are required to be held by banks, increase the capital levels that are being required, and meanwhile, once again, the federal budget came in and increased taxes on banks as they did last year as well. So the taxes basically take cash off the table. The buffer takes cash off the table that's available for lending, and the capital requirements take cash off the table that would otherwise be available for lending. So even though we don't have the prudential concerns that have arisen in the United States, we are seeing a constraint on lending that's been occurring as a result of some of these regulatory moves.
Earl Davis, the bank upgraded its growth projections this year. We've talked about that a bit already. It is being characterized as a suggestion from the Bank of Canada that a soft landing is possible. In fact, that the prospects for a soft landing have increased. Do you agree? Yeah,
and I'll go back to two things we were talking about late 2022. One is we kept using the word resilient, and the economy, both Canada and U.S., continues to be resilient. So could that continue? So that's one thing. The other thing is, you know what? 2023 is going to be a year of hard hikes. 2022 was a year of easy hikes. Inflation was skyrocketing. You had to get interest rates lower. But it's going to be a year of hard hikes and hard decisions going forward.